Hey everybody, welcome to this free edition of our Trader User Group. This is for the weekly roundup for the trading week ending November 13th, 2020. I'm Preston Brenton. Thanks for tuning in. Remember guys, don't be a rat brain trader. You want to be the red striped zebra, and this week's theme is, well, I guess you could say markets are like a box of chocolates. Every day you open them up, you don't know what you're going to get. But speaking of a box of chocolates, let's take a look at what we did this past week. I think we're still in this momentum run to the upside. So let's go just kind of take a look, see where things are kind of slicing themselves out here. If we take a look at the U.S. markets, you can see the Dow, S&P, and Russell all had a strong week this week, all up in the green year to date. Everybody's in the green. The only one that suffered this week was NASDAQ. It was down a little over 55 basis points for the week, which continues to show that little bit of a shuffle I've been talking about for the past couple of weeks of value over growth. You know, technology, we're getting some profit taken as we come through the end of the year, and markets are moving more into value related travel and leisure, primarily with the potential epidemic ending vaccine announced by Pfizer. More to come on that in a minute. You can see the PE ratio, the trailing 12-month, a whopping 40.37. A lot of that has to do with the huge crash in March and then roll back again. If you look at the forward PE ratio, it's still really high at 25.65. The forward is about 36% less than the prior, but we want to focus on the forward 12-month. This is what the expectation is. So you can see that the PE ratio is relatively high, especially where the current volatility is. You can see the S&P dividend yield has come down a little bit, which you would expect as the S&P moves higher. The dividend yield is at 1.70. The 10-year Treasury continuing to edge higher. This week it finished up 89.3 basis points. That's almost 1%. The spread between the 10-year and the S&P has come down, almost cut in half. Now it's at 47 basis points. So that means big money as it goes into the S&P in a basket of stocks looking to make a little bit more money. The money that they're making extra is not as much anymore the higher that 10-year goes up. And if we look at the current VIX, it closed out the week at 2310. Last week it closed out the last week at 2484. So only down about 7%, but the volatility still is elevated given that we're near all-time highs, particularly since we made all-time highs in most indexes early this past week on Monday when the Pfizer announcement came out. If we look at the sector performance for the week, you can see the best performing sector was energy, 15.75. The worst, technology, as I said, continuing in the vein of profits coming out of the technology sector, which is pretty much still strong year to date. You can see technology year to date still up 33.56% for the year. Energy is still bringing up the rear at 40.61%. But if you look at the year to date, we're all in the green now. Dow, S&P, NASDAQ, the Russell, which had been trailing since 2018. The last all-time high in the Russell was in 2018, early September of 2018. Now, year to date, it's up very nice, right? For the Russell. So we're seeing everything really just move nicely. Now the Russell index, it's not, I don't think it's 14%. Year to date, the Russell is, year to date, it's up 4.53%. So just skip that extra one in there. But the Russell is still up 4.53% for the year. Now, if we look at the international markets and just kind of see where everything is there, again, for the week, everybody had a very strong week. China was basically flat. But if you look at those markets that are in the green year to date, mostly Asian markets with the exception of Hong Kong that hangs in because they're having trouble with China and Chinese rulers coming in and kind of taking over their legislature and everything. But year to date, everybody across Europe, the FTSE, which is London, CAC 40, which is France, the DAX, which is Germany, which is, you know, drives the ship for the ECB, those 19 countries that make up the ECB. They're all in the red year to date, right? A lot of them are still closing down. The countries are closing down. So it's put a little bit of a panic over there. But you can see that the Asian markets, the Nikkei, the Japanese markets, and Chinese markets are up nicely for the year. So in the green, all U.S. markets continuing to lead the way, and then China and Nikkei, and then everybody else, every big market is in the red. Now, if we come over and just kind of do a little bit of a soundbite action of the prior week, and let's just take a look at it by the index performance. As I said, the Dow and smaller cap Russell performed the best, right? While slower growing value shares really easily outperformed their growth counterparts like NASDAQ, tech shares within the S&P, all trailing most other sectors. I mean, earlier in the week, the Pfizer news kind of prompted a really sharp rally in cyclical stocks, travel and leisure, which is where I've got a lot of our members focused as we get some of these vaccines going. Return on capital, you're going to do better in travel and leisure short term. Now, longer term, I'm still not bearish technology, but I just think return on capital, those guys have been punished so much that they're going to make up at least half of their losses through the pandemic once these vaccines hit. Now, we're supposed to get Moderna's announcement also probably in the coming days. So I suspect this week, if it comes out like Pfizer, we'll get another 20, 30, 40 point pop in the S&P. We'll continue that momentum that we finished on the weekend last week. Okay. So that's a little bit about, kind of what we got for the index performance. Now, the economic data is relatively light this past week, kind of a mixed picture, but we did get jobless claims falling a little bit more than expected. It's reached a new pandemic low of 709,000. Now, while that's still up, it's still coming down slowly, and continuing claims fell below 7 million for the first time since March. All right. We did get a measure of small business sentiment, and it's kind of remaining steady at the pandemic highs, right? So small businesses are still optimistic, but if they start to shut down in the northern states, northeastern states, and out west, that's going to put a little bit of a monkey wrench in that. And we did get this past week the University of Michigan's preliminary measure of consumer sentiment in November came down just a little bit. It's at a 3-month low. So, that would be expected here. And then, of course, if we look at treasuries, as I showed you in the yields, the yield on the 10-year edged higher this week. As I said, it in the week up 89.3 basis points. Okay, so it's moving up just a little bit. And we saw it surge highest since March on the Pfizer announcement on Monday, But yields did decrease on Thursday, and as we went into the end of the week, still finishing higher, but pull back a little bit on new lockdown fears, also weak inflation data, all of that stuff kind of helped push it down. Investment grade corporate bond credit spreads, which is really the yield offered, the additional yield offered over treasuries, tightened on Monday, which is more optimistic, but it continued to widen just a little bit during the week. Now, for our members, maybe not this Sunday, but maybe prior to the big holiday weekend we have, or holidays we got coming up here in the U.S., Thanksgiving in the next couple of weeks, I'll review the importance of debt versus equity and credit spreads between investment grade versus corporate debt and junk bonds. It's very important that you understand it. You don't need to trade it, but you need to understand it, because the credit markets drive the equity markets, not the other way around. So we're going to go in a little bit more detail on that and how you can follow it using Thinkorswim. So that's kind of what's going on in the treasury market right now. If we look across Europe, they're continuing to shut down. And at the ECB annual symposium, the president of the ECB, Christine Queen Bee Lagarde, signaled that the ECB, the central bank there, is ready to expand its pandemic emergency purchase program. They call it the PEPP. They bought more than 640 billion of euro of bonds, and it's targeted longer-term refinancing operations, the TLTROs, they got abbreviations for everything, has lent out almost 1.5 trillion euros to banks at very low rates. Okay, so basically Queen Bee Lagarde came out and said all options are on the table. So they're going to stand by and do what it takes there, much like Jerome Power Ranger Boom Boom Powell, our illustrious central bank president, chair, said here as well. So you got central banks in Europe, central banks here in the US, central banks in China, and the PBOC and Chinese Communist government all backing the economy. So there's just a ton of liquidity flowing out there in the markets right now. And markets near term love liquidity. Members, I will go through when I go through the corporate bond credit spreads and investment grade debt. I'm going to show you where the troubles really lay for the markets. I don't see this really rising to cause much agita until late 2021, 2022, but it is going to cause the mother of all bear markets, but not now. But members, I'll go through that with you in more detail so that I'll show you how we'll be prepping for that. Meanwhile, if we come over to China, over in the Asian markets, U.S.-China relations are continuing to suffer a little bit, and we saw more of a setback on Thursday when Trump announced an executive order prohibiting American firms from investing in Chinese firms. That the Trump administration claims continues to have ties to the country's military. So that is weighing on Chinese equity markets, which prevented China from really finishing in the green this week. And the other thing that Chinese equity investors received more unwelcome news from the Chinese government is the Chinese government is continuing to draft antitrust guidelines, really really aimed at curbing a lot of the power of the country's leading internet-based platforms, which is one of the reasons why they halted the Ant public offering, which suffered, it really caused some big issues over in China, including shareholders of Alibaba. Baba fell back big too because Baba owns about 33% of Ant. So that's just caused major league issues. All right. So what I want to do is just kind of show you the markets here in the U.S. I just want to give you a quick soundbite of the markets as we stand. I'm going to shift you over right now and show you the. Let me just get the screen up for you. Give it a second or two to paint the screen for you here. What you're going to be looking at is the Russell, which is small cap Russell 2000. You're going to see this Friday. On the Russell right here, we made new 2020 all-time highs. We also moved into the green for the year. You can see the 2019 closing price on this daily chart. We moved into all-time highs. The last all-time high with the Russell was made in September 2018. You can see here on the MACD, there is no divergence here, so that's been a solid move higher. And this goes along with that rotation I've been telling you guys about, where we've seen money shift from growth to value, growth to small cap. Remember, the last time we had this happen was September, October, and part of November of 2019, and then it ended abruptly as it started. I think this one may have a little bit more legs because the Russell has been trailing for a long time. And what we're seeing is money rotating, and as the vaccine, if the vaccine comes out shortly and starts being distributed in 2021, I think they'll do emergency use in this year, towards the end of the year, but basically 2021. Then I think you're going to see this rotation continue a little bit because I think technology just got a bit ahead of itself. Longer term, you still should stay bullish technology, but you can just see this rotation here. And if we look at the S&P, but equal weight S&P, remember, if you look at the FANG, the Facebook, Amazon, Apple, Netflix, Google, and Microsoft, that accounts for about 23% of the entire value of the S&P. But if you take every S&P company and give them 1/500th of a weighting, this is what it looks like. Notice we were in the red all the way up until October the 6th, which meant the S&P was being held up primarily by tech. Once money came out of tech, we saw a lot of these other smaller companies in the S&P and primarily the Russell kick in gear, and we made new all-time highs in the equal weight. So when you look at this, the good news is we're getting other stocks pick up the lift and the burden from some of the pullback in tech, okay? And we're seeing some of that shift and some of that rotation. And you do not see this in a bear market, guys. Traditionally in a bear market or the beginning of a big bear market, it is very common to see leadership getting more narrow by some key stocks. And then when those key stocks roll over, other stocks do not pick up the lift or the burden. In this particular case, we're seeing that. So that's a good thing, right? And for the near term. And I would define near term as going through the end of the year through January, February as we kick off 2021. So you can see this here now. It did form a gap, and I could see it attempted to fill the gap. It pulled back a little bit on the 12th, but I think it's going to hold for the near term. And that's kind of what I'm seeing here on these markets. Now, if we come down and we look at volatility, you can see the VIX continues to drift lower. This was the month of right in the middle of October. We had that little bit of a dip, and then we came right back down again. Or we had the dip in the markets. We created the we actually went up over 40 in the volatility, but we've come back down, almost cut it in half. I mean, the VIX was up around 41.28. Now we closed the week at 23.10, so almost cut in half, right? And I believe through the end of the year, remember November and December also tend to be historically very bullish for the markets. And you throw in year-end holiday season, I think you're going to see tremendous surge in online shopping. Amazon, FedEx, UPS, all are hiring 20, 30, 50, 100,000 more people to get through this year-end crush. So we're going to see some strong numbers here. Consumer credit, as reported by Citi and some of the other large credit card companies, are saying that they're not spending as much, meaning they're saving. So I think there's some money on the sidelines, not only to go into the markets, but to go into retail shopping for the holiday season. And you'll see some of these things just take off. So I think that all promises to show a strong finish to the year. And as I tell our members, February, March, we could expect a little bit of a pullback. Members, I'll go through that with you on our weekly market watch this Sunday evening. If you're not part of our group, I highly encourage you to come in. We're having a lot of fun playing these markets. And just, not only the interest rate and equity and debt, but we're also into the commodities as well. And speaking of debt, if we look at the bond market, you can see here how the bonds have shifted. For the longest period of time, we were trading the bonds in an upper tier, and then as bonds started coming down, I said it's going to trade in a new range, which is what it's doing here. But I think longer term, bonds are going to continue lower. Okay, they're not going to go higher. Now, it may go higher if we have fear in the markets with some sharp down twist in the markets near term. But longer term, I think bonds are going to go lower. And if bonds go lower, then what do we know? We know interest rates here are going to go higher. You can see interest rates are just slowly ramping themselves up, trying to get above their 200-day moving average right here. We cleared it for a day, and then we pull back just a little bit like this. But I think that's going to continue. And notice there's no divergences here. So that means any pullback in interest rates, which means any rise in bonds, you should sell off the bonds on any rallies. And buy the dips in interest rates if you want to play interest rates to the upside. I mean, that to me makes the most sense right now. Okay. And if we look at currencies, dollar is going to continue its slide. You can see the dollar, I don't think is going to have a hard time getting above the 50 EMA. I've got a shaded zone here. My target for the, not bonds, the dollar, my target for the dollar is around 91. And that's kind of where we're going. You can see the 2020 low right here in August. I think it's going to take it out and continue lower. And again, going back to my bullish play, I am bullish the euro. And I've been saying this for quite some time. I think the euro is going to come up. It's going to come up and touch the 120, probably run even higher than that. Bull put spreads, if you want to do the credit spreads and puts on the euro currency, or you could do, members, I've taught you guys how to, in our option masters, how to do long euro futures and then sell euro future calls against that position to hedge downside. I've shown you guys ways to make those trades. I think we're going to take the 2020 high out and we're going to continue higher. Okay, so that's a little bit about what I see in the currency market. If we look at the yen, because the Nikkei is just going higher and higher, but we're still seeing the yen just nudging higher. So that concerns me a little bit. Remember, the yen is a flight to safety. You can see back over here in March how the yen just shot straight to the moon when the markets crashed. So the fact that we've got the yen making higher highs and higher lows concerns me just a little bit. Okay. Typically when the yen is moving up like this, the Nikkei is moving down and vice versa, but we're having the yen and the Nikkei moving up. So something is going to self-correct here. I believe the yen is going to go lower, but looking at this chart, you would say near term, it doesn't seem that way. but we're going to see a self-correction here shortly in that. Now, the British pound, I'm not doing anything in the pound until they get the Brexit. I was hoping for a deeper dip down in this area down here around 123. We did not get it. Because the news coming out of Great Britain right now is I think they're, even though they're plodding along, remember the vote, the yes vote to get out of the European Union was back in July of 2016. You know, hell, we're in November of 2020, and these damn politicians still hadn't figured out how to exit from the Europe. So eventually they're going to figure it out. And I don't think there'll be any more extensions. We'll get some chop in the pound. And then when they figure out it's not going to be as bad as they thought, I think the pound's going to work its way back. Longer term, I would be bullish the pound. Short term, I would stand aside and just see what happens. Okay. If we look at metals, let's look at gold. Gold has been very schizophrenic. I am not playing gold right now. Remember, back over here, we played gold to the long side. We had beautiful patterns that set up to suggest long gold, but we chose long silver because the return on capital, silver was outperforming gold. So we played silver, and now we're just in this wide chop range. I think longer term, gold's going to move up. I've got a target of around 2,200, but not now. We got to clear out some of these major trading zones here. Once we break, let's say 1990, and we start moving up, we may retest that level, but once it's broken, it's going to start running. It'll make the new 2020 high of 2089 and just keep right on running. We're not there yet, guys. The other one that interests me is copper. Now, we're still bullish copper. We're kicking butt in copper here. You can see we got long copper down in this area here right out of March 23rd, to be exact, early March, or first week in April, rather, I'm sorry. We got long copper. Now, we have members that went long copper futures. We chose Freeport-McMoRan as our trade of choice. I put out about 10 different companies that you need to be long in early April. Every one of them's knocked the ball out of the park, but copper's just done very well. Okay, and we traded it using Freeport-McMoRan. We'll review these trades again tomorrow evening in our weekly market watch, but it really, and we had a number of traders that followed us in the trade, so it's going to be really cool. For our members early this week, coming up in our secret trader, I'm going to be releasing some new trades in SPX and the SPY that I think you guys are going to really enjoy. High probability trades where we can make some money on this thing, and let them, and we don't have to pick market direction. Let the market tell us what we want to do, and then we'll just adjust the trade accordingly and pull our money out every 20 to 30 days. So that's just another trade that we got coming, setting up here on this one. But copper, I love, right? It's just a really great trade. Let's look at oil right now. Oil had a strong week, but you can see here, we went from down here around 34 all the way up to 43. Almost $9 a barrel. It pulled back the last couple of days of this week, but it just had two huge moves, primarily in the pandemic. Remember, oil is driven by the global economy. If the pandemic is stopped in its tracks by a vaccine, that means all these manufacturers, everybody else is going to turn the boilers on, and they're going to start burning fuel, and people are going to get out and travel more, and airlines are going to start using more JP4, JP5, jet fuel, diesel, all this other stuff. That's bullish oil. Any delays in that or any negative of that is going to push oil down. All right, so that's kind of the net of where we are over the next 90 days. Now, oil tends to get bullish or bearish in November and bullish in December, January. So we're going to see how it plays out. Nat gas, if we look at the nat gas here, you can see I was hoping for a big move even higher. I wanted to get nat gas up in this area, then I'd be more interested in shorting nat gas. I don't know if it's going to have the energy to do it, but that's what we're going to be looking for. All right, everybody, that's just a quick overtake, our take of the equity markets and some of the debt, currencies, and just high level view. Members, I will see you this Sunday evening. We'll spend a lot more time on it. We've got some winners out there that we're looking at, and potential new trades coming up as we kick off this next week. Everybody else have a great weekend. I will see you members this Sunday evening. Take care, folks. Ciao now.